Well, I'd like to welcome everyone for joining us. It's my pleasure to act as moderator for this afternoon's event, and I'd like to introduce you to our speaker. He is Ryan Clements. He holds a chair in financial regulation at the University of Calgary Law School. He has law degrees from Canada and the United States and is completing a doctorate in law from Duke University in the area of financial technology. He's published an astonishing number of papers in a very short academic career, and I'll turn the time over to him.
Thank you, Bryce. Pleasure to be here. Grateful for the chance to be able to speak on something that I find to be a very interesting market development and really quite a remarkable financial product, which is the exchange traded fund. I'm going to give just a quick roadmap of what I hope to do today. I recognize that there's going to be people on the call who have extensive knowledge of exchange traded funds, and there's probably some on the call who may not know what it is. I'm going to take a little bit of time to discuss some context around an exchange traded fund, including what it is, why it's become such a popular investment vehicle, and then also why it's become quite a polarizing investment vehicle as well, and direct and identify some of the prior to COVID concerns that were starting to surface in the literature. And then after that, I want to have a discussion quickly about what has happened really mostly in March and since March with respect to the COVID pandemic in the exchange traded fund sector. And then we'll open it up for some questions. So first off, I'd like to say that the exchange traded fund, it's truly remarkable investment product. I don't think it's overstating to say that it likely is the most successful financial product since the 2008 crisis. There's been an absolute surge in popularity and variety of these products. So let's just start very quickly with what is an exchange traded product. Well, I've got a description you can see on the screen now. A simple way of describing exchange traded product is that it's an investment vehicle that provides exposure to an underlying asset pool in a similar way to a mutual fund, but it's traded on an exchange. And so one of the easiest ways to understand what an exchange traded fund is to compare it to a mutual fund and look at what it's not. So with a mutual fund, you have the ability to redeem directly with the issuer of the fund. With an exchange traded fund, you can get exposure to an underlying index or underlying basket of assets. And I'll note that as the exchange traded fund universe has grown in size and variety, and I've got some statistics from ETFGI with respect to global data, over a $6 trillion market at this point with nearly 7,000 global products. And that doesn't even include exchange traded products, which I unfortunately don't have time to get into today. But the level of potential underlying asset exposure is extensive. But when you buy an exchange traded fund, you're purchasing it off a secondary market. So the secondary market trading dynamics like bid and ask apply to you. You don't have a redemption right directly with the issuer of the exchange traded fund at net asset value. So when you go to buy an exchange traded fund, you want to ensure that you're buying something that isn't trading significantly below its net asset value. And correspondingly, when you go to sell an exchange traded fund, you want to ensure that you're selling it something that isn't trading significantly below its net asset value, and you don't want to buy significantly above its net asset value. Well, how does this all take place? It takes place through a really unique and novel market microstructure called arbitrage. Certain participants, large financial intermediaries, can perform a creation or redemption process with the ETF fund issuer in a process that we call arbitrage. It acts a simple way of describing it, and this happens on a programmatic basis, and it's quite sophisticated in the actual application of it. But simply described, if an ETF was trading below its net asset value, one of these arbitrageurs could sell short the underlying basket of securities. They could, if it's trading below its net asset value, then they can buy the ETF and they can redeem the ETF and at the same time sell the underlying basket short and receive back from the ETF issuer the underlying basket to close out the short. So this is something which is a a market incentive, not a legal obligation to provide. But the working of this arbitrage function allows for the net asset value and the secondary price generally to be aligned. And up until COVID, dislocations between the net asset value and the secondary market trading price happened. There was a few market incidents, but generally speaking, it functioned pretty well. The popularity in ETFs are driven by a number of factors. First, they fit within the universe of the passive indexing revolution. As investors have become somewhat disillusioned with active management styles, it provides a low friction diversification access. And because of this arbitrage function, ETFs trade intraday. So you have intraday liquidity, which makes them beneficial to some traders and distinguishes them from a mutual fund structure. Also, ETFs have opened up access to difficult and opaque and underlying asset classes, which has helped with their popularity as well. They're also used by fintech platforms, robo-advisors, rounding up platforms, things like Acorns, Milo. You've seen the proliferation of a lot of these structures. We just lost the slide there. I'll just keep going. You've seen the proliferation of these structures from things, or from the ability of ETF issuers to duplicate novel structures. You've also seen an interesting dynamic in that fixed income, low duration credit ETFs are becoming used as cash substitutes. And also in the context of all this, you've seen certain ETF issuers, particularly three, BlackRock, Vanguard, and State Street, grow in significance and prominence. And as this has happened, as I've mentioned, you've seen what's been described as a bewildering variety of ETFs, including conventional index tracking, bespoke and novel indices, tracking of sectors, asset classes, entire economies, and a variety of different structures, including active, non-transparent, smart beta, factoring, leveraged, inverse, and then a whole bunch of replication strategies as well. It's one area with respect to the regulatory structures that I'm quite interested in is how are the investment disclosure regimes working to deal with this increasing product complexity. Okay, so you have this product. Take a step back here. We have this product. It is novel. It is very beneficial. It's very popular. Well, then why was it being criticized in some academic and industry circles, including by certain prominent market participants? Why are some of the reasons why it was being criticized even prior to the COVID market event? Well, let me just point out a few of those things, and we can touch on more of them in the question period. First, there was a concern that this arbitrage mechanism, and remember, the arbitrage mechanism, it's discretionary, it's market-based. There was a concern that these intermediaries who perform this arbitrage to ensure that the net asset value and the secondary market trading price of the ETF is aligned, there was a concern that some of them might step away in a crisis, causing the net asset value to dislocate from the secondary market trading price. And the concerns were basically based around this idea that any form of arbitrage in a crisis is very difficult, particularly when there's a mismatch in liquidity. In order to perform effective arbitrage, you need an information rich, highly liquid, highly robust asset class. And in prior market events, particularly 1987 with portfolio insurance, there was difficulty performing arbitrage between futures and equity components. In ETFs, there were some concerns that in certain type of ETFs, where the exposure to the underlying asset class was in an illiquid asset class, things like certain types of credit products and bonds, that the arbitrage function could break down. And there was also a concern that these authorized participants who perform this function might just step away completely if their risk profile changes. hedge fund manager, Howard Marks from Oak Street Capital, first pointed this out early 2013 and compared it to the auction rate securities market, where discretionary liquidity provision can be fragile in a crisis. There was also concerns, and this comes in with the larger concerns about passive investment altogether, that ETFs were contributing to a less information sensitive market, meaning the price value of the securities were potentially becoming distorted because ETFs were facilitating trading on the systematic component of risk, not the idiosyncratic components of the underlying securities. In addition, there was concerns that ETFs were facilitating more trading, more activity, more transmission of noise, co-movement between the index and the underlying assets, and co-movement between the with the underlying assets themselves. There was concerns about potential herding risk. There was concerns about ETFs being used as cash substitutes, and thinking back to 2008 and how, you know, things like asset-backed commercial paper found their way into money market mutual funds, and how that created problems in the cash substitutability for money market mutual funds. There were some concerns saying that, are some of these fixed income ETF products being used as cash-like substitutes by institutions? There was also concerns that emerged about risks with respect to concentration in the industry, concentration not just with the ETF issuers themselves, but also with the authorized participants, and market makers and official liquidity providers, and whether or not that type of concentration could impact the arbitrage function in a crisis. Now, up until March, the general sentiment was that ETFs really hadn't been truly stress tested in a crisis. And now, perhaps for the first time ever, we've had a true stress event where we've been able to see what's happened in this market. And this is, again, I would say that the polarization continues right now, in that you seem to have almost battle lines being drawn. And if you've been following the sector and reading the popular press, and even seeing some of the research reports that come out, there seems to be, on the one side, sentiment that they performed extremely well. There have been other thoughts, and I can get into the details of why that is. And I think that there's truth to both sides. There's also some thought that they perhaps have acted as a bit of a panic accelerant, or perhaps contributed to shock-led markets, okay? But in any event, what we saw in March was initially unprecedented levels of discounts in certain ETF sectors, primarily fixed income and some emerging market equity. When I say price discounts, what I mean is that the trading price was trading below the net asset value of the portfolio underlying the ETF. And now this has triggered a lot of the contention about why that is, because those who strongly support that the ETFs have kind of passed with flying colors the stress test say, well, the ETF themselves acted as a liquidity wrapper, or a release valve, if you will, and prevented a feedback or a contagion to the underlying asset. And I would agree with that. There's others that say the fact that the ETFs were trading below the net asset value of the underlying securities shows that the ETFs can absorb information faster than the underlying securities, particularly with respect to bonds. And so the ETFs were actually performing not just a liquidity wrapper or a shock absorber function, but they were actually acting as a price discovery vehicle. Now, there are others who are saying, well, in order for it to be a price discovery vehicle, we have to assume that people were trading on signal and not noise. And we also have to assume that there's no panic accelerant in that dynamic, and that it actually was looking to true price discovery. And that's where it becomes really interesting in terms of the data. I think it's too early to really know exactly what it is. I think there's good arguments on both sides at this point. But one thing that leads into the gray bubble there is that regardless of whether the true value of the net asset value in certain ETF products that became dislocated was the secondary market trading price of the ETF. The Fed in the United States acted very quickly in terms of supporting this market, and actually in an unprecedented fashion looked to create a stimulus. The Federal Reserve in the US's secondary market corporate credit facility included for the first time ever the buying up of ETFs. This has been a move which has been both lauded and criticized as well. Lauded in terms of the Fed preventing a sell-off in the underlying, preventing a cascade, preventing feedback loops in between ETF markets and underlying markets, but criticized in a way that perhaps in creating a functional liquidity provider of last resort and a form of moral hazard in the market as well. And so these are debates which are having, which lending, as a legal researcher, my focus is more on the regulatory mechanisms around both disclosure and systemic risk with respect to this market. You know, the idea of, are they the true price discovery vehicle, or are they accelerating panic? You know, I think the data is probably too early to say that. I think that I think one of the things that we have to look at in this sector is, what truly does an ETF do? If an ETF is meant to give a real-time tracking of an index without tracking error, well, then perhaps there's some areas that need to be adjusted. However, if the ETF is to provide liquidity and to act as a price discovery vehicle, well, then I think ETFs have done extremely well, particularly if you consider that in any crisis, like we didn't have a liquidity crisis at all. ETFs continued to sell. The challenge was that they just sold at discounts, and perhaps you could look at the discount as that's a liquidity premium for selling in the context of a crisis. So the concerns about ETFs continue. I don't think it's been resolved with respect to this, but I do think that there's some support in terms of the a mechanism itself. A couple things I'll just finally say, and then we'll open up to questions, is that there have been a fair number of ETFs during the crisis that have shuttered. There was significant price dislocations. You know, Citi put out some research saying that 80% of all fixed income ETFs had all-time high trading discounts, but there was, I believe the last count, about 72 ETFs that actually have shuttered. There has been some concern, those of you who are interested in the idea of the problem of complexity, let's say, or the problem of, can we have too many trading products? There's been some interesting articles that were put out, one actually by the CFA Institute in January 2020, and then a recent article actually by Jim Allen, who's a head of capital markets in Americas for the CFA Institute, talking about whether ETFs are contributing to these shock-led, whether too many products and product complexity is something we should be concerned at. These are things that we're going to have to get into. But all in all, I guess from my perspective, the synopsis is there is support for that. There is some stress test performance in ETFs, but some of these concerns continue to linger, and more data is necessary to really formulate conclusions on this. So with that, I can get into any of the things I talked about in much more detail. Let's save some time for questions here.
Thanks very much, Ryan. One question is, what percent of ETF markets do Western democratic governments own?
When you say Western democratic governments, are you referring to the actual purchase of ETFs via stimulus mechanisms by governments themselves?
Yeah.
Well, first off, the SMCCF, so the Secondary Market Corporate Credit Facility by the U.S. is a new stimulus. The process is the process of purchasing ETFs is actually going to be managed by BlackRock, which has led to a lot of criticism in and of itself, particularly with BlackRock's financial operating system, Aladdin. Some are concerned about the conflicts that exist with respect to that. The total proportion of ETFs and the purchasing isn't, it's just barely started. And so the proportional interest of sovereign government ownership relative to the market is unknown, although it's not unprecedented for sovereign governments to purchase ETFs, and Japan has been in the market of doing that for some time now. And so that, I don't know the exact percentage of it, but it does lend itself to an interesting and important question. Like, if we take the American case, for example, are we now saying that the Fed is looking at buying these ETFs as cash-like substitutes, and so then this liquidity provision is a form of social cost, or is the Fed purchasing of ETFs a more efficient vehicle to support the underlying bond market, which it might be? So this is more of a direct economic stimulus, and this was a more efficient mechanism to do that. It does beg the question, I was mentioning this to one of my students yesterday, of the meaning of money and the meaning of markets, for example, that these are some questions we're going to have to ask. But the Fed, at least in the United States, for sure, has looked at ETFs as being a systemically important financial vehicle.
Tell me, do you want to talk just a bit about the impact of ETFs on corporate governance?
Yeah, that's a great question. And for those of you interested in that question, I'd refer you to several researchers: Lucian Bebchuk, Scott Hurst at Harvard, John Coates, John Coffey. There's been some really interesting scholarship over the past year with respect to what are the implications on boards and governance of this, not just ETFs, because when we talk about governance, we have to also include other type of indexing products, including mutual funds. The idea is, or the legal significance is that in both of the structures, the voting rights with respect to the underlying securities don't flow through to the investor. They are held by the fund issuer themselves. Professor Lucian Bebchuk and Scott Hurst put out a paper just recently called the Spectrum of the Giant Three, I think it was called, that was talking about the BlackRock, Vanguard, and State Street, as of right now, have combined nearly 20% voting control of all companies in the S&P 500, including major banks side by side, major industry competitors side by side. And because of the nature of the ETF industry and indexing in general, both the demands for indexing and the operation of indexing, it's likely that those numbers are going to increase. What does now the criticism about intermediated ownership or common ownership is that the ETF issuers don't have the incentives to ensure that management, or they have incentives to defer to management. But these are some, these are some interesting questions. I don't think it's really settled in terms of what that is. You're seeing some interesting signaling in the market, particularly with Larry Fink, the CEO of BlackRock, about moving towards more of a stakeholder capital model. That's being criticized as to whether or not that's even possible or good. These are some big questions we're going to have to ask, because in addition to the market inefficiencies like price discovery or cold movement of underlying assets or increased volatility and noise trading, John Bogle said it best that if all individuals indexed, the markets could fail, not just because of lack of price discovery, but because of this other dynamic in terms of proxy voting. And so it might, John Bogle, before he passed away, he's the founder of Vanguard, said that this might be a form of a tragedy of the commons in the way, where it's rational for you and I to index, it's rational, and the empirical evidence supports it in terms of performance of investments, but yet there are these other implications of everyone indexing, concentrated proxy voting control being a chief one.
One of the questions is, how is it possible for an average investor to assess whether or not an ETF is trading below its net asset value?
So that does get disclosed on websites. So you can see both premium and discounts on And there's in the US, for example, recently there was a Rule 6011 which came out, which moved away from intraday net asset value, but net asset value is disclosed, and premium and discount between secondary market trading price and net asset value is disclosed on the website of ETF issuers. But when you get into questions of trading, this leads into some of the other concerns that I never brought up. In 2018, the SEC subcommittee on fixed income put out an interesting report where they talked about a market event in 2013, which many of you will know as the taper tantrum. So when the Fed announced easing up and tapering off quantitative easing, there seemed to be empirical support that is in a secondary paper which the SEC cited, showing a significant amount of short-term traders selling off credit ETFs, which had a disproportional effect on the underlying bonds. I bring this up because there's this interrelationship between secondary market trading and primary market trading. And when we talk about things like premium, discount, net asset value, it implies that we have accurate information for net asset value. And that can be very, very challenging with respect to opaque, over-the-counter, hard and difficult to access asset classes like bond markets. So even if you see a premium or discount measure net asset value, and this is part of the whole challenge right now that we find ourselves dealing is, how do we know that the net asset values are accurate for particularly illiquid underlying asset classes like bonds?
Thanks. And that actually ties into another question which comes to us, and that is, what, if anything, can regulators do to ameliorate the impact of shocks on an ETF's trading strategy, like the one that occurred with United States Oil Fund?
Yes,
which,
yes.
for obvious reasons, last month suddenly found itself in a bad business.
So United States Oil Fund is an interesting one because, you know, there's some, I've read reports that say, you know, that the fact that oil futures went negative for the first time can be blamed on the USO. Now, why could that be? Well, these USO or these ETFs aren't designed to take delivery of oil, and so they invest in oil futures, and so then they have to roll over the oil futures, and that can cause some bad timing. And so, you know, to get to your question, what are the implications? Well, there's a whole bunch of dynamics in this. Okay, there is regulatory implications of, are investors appropriately informed of the unique distinctions between an ETF and a mutual fund with respect to how this arbitrage mechanism works? Okay, are we doing a good job with that? That's a concern. Are there concerns about things like exchange traded products that invest in futures contracts, or that provide some type of a synthetic return, or that reset daily? And that ties into the universe of inverse funds and levered funds, okay? That's a concern. Another concern is, are the rules of the road, so to speak, so things like circuit breakers, are the same rules of the road that we apply to securities markets and equity equally applicable in the same fashion to ETFs, given this primary market, secondary market distinction and this arbitrage function? That's a significant matter. You know, bringing up even the USO, I have seen, and I don't really fall too much on this line as much, but I have seen some calls for more paternalism even, and greater restrictions on access to certain types of products that really are just a speculative bet on the movement of, and you bring up USO, you know, another analog we could tie into this is in February 2018 with the VIX and the inverse VIX products as well. In 2018 in February, after a fairly tranquil, sustained period in the markets, you saw a volatility spike. The volatility spike was followed by a huge sell-off in inverse VIX, so exchange traded products, and not exactly ETFs, slightly different, but nevertheless, it ties into your question. There was a huge movement in these inverse VIX products, which created a feedback effect on the VIX itself. And so there's been some calls for, well, maybe we need better and stricter ex-ante product approval rules, and restrictions with respect to who can access, because retail investors can't easily access futures trading in oil contracts, but they can easily access the USO. Is that good? Does that lead to better discovery of the price of oil? Or is that something that is basically facilitating an opportunity for panic acceleration and then making the markets less price informative and more potentially volatile? These are important questions.
Well, Ryan, I'd like to thank you for sharing your expertise with us and insights today. And I'd like to thank everyone that tuned in. Please keep an eye on your inbox for a follow-up email from the School of Public Policy with a link to future webinars. And I believe this webinar will be posted. As well, I think Ryan is, if you wish to reach out to him, Ryan is happy to answer questions or continue the conversation in other formats.
Absolutely.
Ryan, thank you again. Much appreciated, and we wish all of you a very safe day. Take care.
Thanks a lot. Take care.